Welcome to The Explainer. Right now, we're watching a massive financial standoff play out at the absolute peak of UK politics. And honestly, it's a dynamic that's going to dictate how your local roads, hospitals, and towns are funded for decades. We're talking about the new Prime Minister, Andy Burnham, his incredibly ambitious plans to reshape the entire economy, and the very powerful, very watchful eyes of the global financial markets. It's this classic, high-stakes clash between a bold political vision and the ruthless, mathematical reality of government borrowing.
Which brings us to the multi-billion-pound question we're exploring today. Can Andy Burnham's bold regional vision actually survive the ruthless reality of the bond markets? You know, when a leader comes in promising sweeping changes, massive infrastructure, and a huge transfer of power, the very first thing the global financial system asks is simply, how on earth are you going to pay for it?
Okay, let's dive into this. We'll be looking at the Burnham devolution plan, how to fund the Northern Powerhouse, the arrival of the bond vigilantes, a quick market reality check, and finally, what investors are watching.
Part 1. The Burnham Devolution Plan.
So Andy Burnham is essentially dragging his regional mayoral mindset right through the front door of number 10 Downing Street, and he's promising the biggest transfer of power in a generation. To really grasp why local leaders are so fired up about this, just listen to Oliver Coppard, the mayor of South Yorkshire. He says this plan is crucial because it escapes the death grip of the Treasury, because historically local governments have had to rely on these strict one-year handouts from Whitehall, which makes planning multi-decade infrastructure projects pretty much impossible. Burnham wants to completely sever that reliance.
The escape route he's using is called fiscal devolution. Basically, it's just shifting the control of tax revenues away from central government and handing it directly to regional authorities. So by April 2027, regions will start keeping a share of business rates, and by 2028, they'll actually retain a chunk of the income tax generated right in their own backyards. It's an absolute game changer for the local funding model.
But what are they actually going to do with this newfound financial freedom? Well, the vision is huge. We're talking the biggest state-funded council house building spree we've seen since the 1950s. They want greater public control over utilities like water and energy, and even the power to offer localized tax breaks to supercharge regional industries. It's incredibly ambitious. But these are just plans. The hard part is finding the actual capital to get those shovels in the ground.
Part 2. Funding the Northern Powerhouse. So, how do you finance something like a massive 30-year underground station project at Manchester Piccadilly? Well, you have to borrow. For decades, councils really only had one option: the Public Works Loan Board. It's run by the Treasury, it's a total monopoly, and because it's a monopoly, it can suddenly hike up interest rates without any warning, which, by the way, they actually did back in 2019. But now, local authorities are looking at a much more flexible alternative: the UK Municipal Bonds Agency. It's owned by the councils themselves, offers rates driven by the open market, and entirely removes those sudden political whims.
And the process is actually pretty straightforward. Step 1. Mayors take those newly devolved long-term tax revenues and confidently lock in major infrastructure projects. Step 2. The UK MBA pools all those borrowing needs together and issues municipal bonds to the financial markets, backed by a joint guarantee from the councils. And Step 3. Investors buy the bonds, handing over the upfront cash to start building. And this isn't just a theory. Lancashire County Council already used this exact playbook to borrow nearly £350 million, and they did it at a noticeably lower rate than the Treasury was offering.
Part 3. Enter the bond vigilantes.
But, of course, if you're selling bonds to the open market, you've got to keep that market happy. If you haven't heard the term before, bond vigilantes are fixed-income investors who essentially hold government's feet to the fire. If they think a government is spending recklessly or rolling out unfunded policies, they protest. They do this by dumping that government's bonds en masse. This massive sell-off causes yields to spike, which absolutely skyrockets the government's borrowing costs. It's a brutal reminder that a government in debt is always at the mercy of its lenders.
Now, what's really interesting about this slide is the incredible tightrope the current administration has to walk, especially given recent history. Think back to the 2022 Trust mini-budget. Those massive, unfunded tax cuts absolutely terrified the bond vigilantes, triggered a market panic, and spun up a borrowing doom loop. Andy Burnham is doing everything he can to avoid a repeat of that. He's firmly committing to strict fiscal rules, basically promising that all day-to-day government spending will be covered purely by tax revenues, not by taking on more debt.
But despite Burnham swearing up and down that he'll be fiscally prudent, the market is definitely still on high alert. David Zahn over at Franklin Templeton pointed out that the general consensus is still that a Burnham government means higher taxes, increased spending, and greater borrowing. So while the Prime Minister is saying all the right things to keep the peace, major investors are basically just holding their breath, waiting to see the actual math.
Part 4. A market reality check.
So, let's look at the actual math. The huge question flying around the financial media is this: is Andy Burnham actually spooking the market right now? Are his big spending plans pushing borrowing costs out of control?
Well, the answer really lies in this number, 4.72%. That was the yield on the 10-year UK gilt right after Burnham gave his initial speeches. And yes, sure, compared to other G7 nations, that is quite high. But here's the crucial context. That yield stayed broadly flat after he laid out his fiscal promises. We didn't see a panic spike. The market essentially digested his message of prudence, and they held steady.
And the academics actually back this up. Professor Kostas Malas ran an analysis tracking online search activity for Burnham's policies against sovereign yield movements. His takeaway? The data clearly shows that Burnham himself has not put upward pressure on borrowing costs. So if the new prime minister isn't the one driving up yields, what is?
Well, it's global macroeconomic factors. On one hand, you've got global oil prices creeping up because of geopolitical tensions, which naturally drives inflation fears and pushes bond yields up all over the world, not just in the UK. But on the flip side, in a bit of economic irony, UK wage growth has actually dropped below 3%, which is the slowest we've seen in 5 years. That slowing wage growth actually takes the edge off domestic inflation, which lowers the chances of Bank of England rate hikes. Ultimately, that could end up giving Burnham's government the vital fiscal headroom it desperately needs to borrow safely.
Part 5. What investors are watching.
So the market is calm for now, but there are some massive milestones coming up that could flip the script. Let's walk through the timeline the financial world is obsessing over right now. We're past July 2026 when Burnham took office. Now all eyes are locked onto November 2026, which is when Chancellor John Healey will deliver his budget. That's the document that proves exactly how these promises are getting funded. After that, we hit April 2027 when those business rates are devolved, followed by 2028 when local income tax sharing finally kicks in.
And this brilliantly illustrates just how many spinning plates investors have to watch, well beyond the headline devolution policies. Come November, they'll be asking, is Chancellor Healey going to increase defense spending, which means more borrowing? Are they going to try some off-balance sheet magic, like a national wealth fund to sidestep strict debt rules? Will they mess with the Bank of England's mandate to focus more on growth? Or are we looking at sweeping new capital gains or land value taxes to plug the financial gaps?
Which leaves us with this final, pivotal thought. We are watching a grand experiment in modern governance unfold in real time. Will this bold vision for regional empowerment actually balance the books, paying for itself through massive localized economic booms? Or will the math simply fail to add up, forcing the bond vigilantes to strike again and deliver a harsh economic reality check? It is an absolute puzzle of geopolitics and finance right now, and these next few months are going to be absolutely critical. If you want to dive deeper into the raw data, the expert quotes, and get a full breakdown of these policies, you definitely need to read the full analysis at londoner.news/Andy Burnham Bond Markets. Head over to londoner.news for even more exceptional insights into the forces shaping our economy.